The candle range theory is the key to predicting every single candle. Now, this is our base template of understanding that every candle is a range. Throughout this entire video, I'll show you guys different patterns that we can start to notice to use to our advantage to predict the very next candle using CRT trading. This is the first understanding that we want to look at the previous candles high and low, because this can be used as our draw on liquidity, okay? This high and this low. If price ends up sweeping the low, we can see this as price taking out an area of liquidity, and then we can then use the high as a draw on liquidity, which would then be our full target. Now, here is the very first example of us using our normal CRT in our favor to predict the next candle. In this example, you guys should be more familiar with this one. It is the 3-stick CRT candlestick formation, okay? The stop and reverse model. First candle being our impulsive candle. Understand that previously we would have been in a bullish trend before the price actually printed this new bullish candle. From this point, you'd mark out your low and your high, okay? The very next candle, the stop/pause in price, once price wick rejects above a certain high point, okay, or this drawn liquidity, we will then see it more likely that price will now make a reversal to the downside, adding more confirmation or confidence to this model, with price simultaneously tapping into a point of interest, whether that be a higher time frame value gap or higher time frame order block. Probable next candle will then be bearish. The stop and go model, where we are following a bullish trend, as you can see right here. We then have our impulse candle, mark out our high and our low. That is the most basic template that we use for each and every model, okay? From this point, you would then look for price to make a stop. Now, this stop is also similar to a pause, but it would be a very minimal bearish candle in a bullish trend, and for a bearish trend, it would be a very minimal bullish candle, okay? All we're looking for is a pullback. The most probable candle being printed would then end up being a bullish candle to follow this previous trend. As it simply stands, a normal impulse retracement and a new impulse model, okay? Now, here is the first example into the CRT. Now, the candle range that forms the range has the low of the range taken out, where we can then see a lower time frame bullish entry model that will validate a long that then purges the range high. Now, the main understanding behind this is that, let's first understand that this is a normal CRT happening right over here. CRT range high, CRT range low. Price makes a wick below this low point and then starts to make a bullish move to the upside, okay? Our normal sweep and go model. Understand that we have now taken out liquidity. It then allows us to see more volatility being placed into the market, which is why we have a high chance of seeing the next candle being bullish from that point, okay? Now let's hop onto a chart so I can actually show you guys some examples of these. As you guys can see, we are going to be using fastball.com charts here, just because they also do have the added feature of having tiled windows, which is very important to us using our CRT model in good confidence, because we have the added ability to use the SMT divergence, which is exactly why I have S&P going against with our Nasdaq. So this is going to be the daily chart of Nasdaq right now, and this is the daily chart of S&P. If you guys do want a link to this exact chart, it will be in the link in the description, fastball.com, which has added tiled windows of over 64 charts that you guys can watch. But I mainly use this in my CRT models that allow me to predict the next candles. As you can see right here, on the S&P, we've made a candle range high, okay? We also are now going to mark out our candle range low, as well as that exact same candle is also being broken above on the Nasdaq. Now, in this certain case, since none have made a certain SMT divergence, you can take either one, the impulse, the pause/stop, and now we can also expect price to make a reverse, which you do end up seeing price doing. Price gaps down and makes that reverse candle. And we also look on Nasdaq right over here, impulse, stop, and reverse, okay? And there you go, you've now predicted the candle. Using your lower time frame models, you can also find an entry within this reverse candle. This is our basic CRT model, okay? Now, once again, S&P and the NQ being played out to us, we have a sweep and go model being formed out right now, because we have just broken not only the high of the previous candle, but also the low of that previous candle. And this is also playing out on NQ. Now, from this point in position, we can't really vary if we're going to have a bullish candle or a bearish candle printed out. So what we're going to have to use in context, we're going to have to use the environment of the trade in our favor, okay? As you can see, you can also see that we're also playing into that previous stop and reverse model. We have price now tapping into this POI. So using this also in good confidence, understanding that with price tapping into a previous POI and also following this bearish trend, we can then have our conclusion as the next candle is most probably going to be bearish. And you're going to have added confidence if you go down to lower time frame to look for the exact same CRT models. And right here on Nasdaq, as you can see also, we do have price tapping into a previous bearish order block. Now, with this added confidence, you can then see that the most probable scenario is that S&P will end up making a bearish candle, which we can then make a decisive moment to actually take advantage of this. As you can see from here, we then have a massive fall to the downside, and as well also on Nasdaq also see a massive fall. This is everything I've just previously taught you guys on not only the stop and go model, as well as the sweep and reverse model, all in the umbrella under the CRT model. This is how powerful this is. This is why I say that this candle range theory can allow you to predict every single candle once using it in correct confluence. Now, I'm just only using 2 charts right now side by side, but if you guys want to take this to the extreme, that is definitely possible. You can just come up here still on fastball.com, add in any of your other pairs that you're looking at, say for instance AUD CAD, you then add that. Now you just then have AUD CAD added as another window where you can now have 3 windows now side by side. So you could also be looking at the S&P, AUD CAD as Nasdaq, allowing you to monitor each and every chart. The link of this site will then be in our description, guys. So make sure to go check that out. Let's go back into some more examples and more formations you guys can take advantage of. Now, this may be the most simplest but most important model you guys have to remember. It is the candle impulse theory. Now, this follows the basic trend of the market. If you've seen the last 2 previous candles have been bullish, okay? In a bullish trend, you can then expect and conclude that the third candle, the most preceding candle, will then end up being bullish as well. Now, how specifically do we take this and use it to actually find that trade to the upside? And that is where the candle impulse theory comes, where you will then focus on, once price has closed, you will then look for price to dip down below into this closing of price. We will then look for your entry model on the lower time frame, and from there you can then look to target higher, okay? But understand that always this is our previous candle high, previous candle low. Price breaks this previous candle high. We then make a new candle low and a new candle high. Next thing that we can expect is that price will then once again follow the same exact trend, break the new candle high, and make a new bullish candle to the upside, okay? Now, this is a very important model I want you guys to also note down. It is the delayed response model. Now, this mainly happens just before news. So if there's going to be a major news event, NFP, FOMC, always look out for this, okay? Because it will most probably play out like this, where we see price create a range candle, where we see our range high and our range low, the simple foundational CRT. From this, you'll then see price to start consolidate. This consolidation, as I said, happens 10 minutes or 5 minutes just before that news event, okay? And from this, we'll then see price make a massive push to either the upside or the downside, depending on where price breaks. If price breaks a low, okay, the candle range low, you would then look and see the next candle actually end up being a bullish candle, okay? And vice versa, if this candle broke above the high, we then expect the next candle to then be a bearish candle to the downside. Now, this is another one right here, the 3 candle anomaly. This is a variation of the stop and reverse. However, it is a fake out pattern to induce others into sells, and the lower time frame CRT evaluation is needed to determine if this is an actual CRT reverse or continuation model. As you guys previously saw, we were talking about the impulse, stop, and then wait for preceding reverse. On this scenario, this is a very rare scenario. But as I say, guys, you can always use added confidence to understand the direction after. Have we tapped into a POI, okay? What are the entry models we are seeing on the lower time frame? Are they either validating to a bearish scenario or a bullish scenario? Now, here's some examples going over all the formations that we've just gone over to predict the next candle. First one, we see 3 candles that are going bearish, okay? Each and every candle is breaking the previous candle's low. As you can see, this candle low has been broken. This candle low has been broken. And now this very new candle low, using historical data, what can we then conclude? That the next candle has a high probability to then be a bearish candle. As you can see, we then also break this next candle low, and then we end up following this trend of breaking the next candle low. All of this, we can use the CRT model to find trades within this. Same thing right here. Candle low is about to be broken, so we can then look at this previous candle close and look for a trade just above the wick. If you guys do need more clarification on this exact model, please watch the previous video, which will be in the link in the description, as well as also join the Discord link where I'll show you guys examples of us trading this exact model throughout the week. Our next candle model right here, we can see the candle range high and the candle range low. From this scenario, what can we conclude the next candle being? First, you have to understand we have just stripped a previous candle range low and we just made a wick. At this point, the candle range high is not being taken out, and this still stands to be our drawn liquidity. So we can fully conclude that the next candle has a high chance of being a bullish candle which breaks above this drawn liquidity. And as you can see, our 3-stick candle formation, price breaks the low, and the next candle right after that, impulse, stop, and reverse, price comes above that drawn liquidity. Same CRT model happening. The next one, we have a scenario where we are following a bullish trend. However, we have just broken this previous candle range low, and the previous candle range high is still untapped. Using this, we can see this as a normal stop and go model. We see the next candle being bullish to follow this previous bullish trend. All it is a previous impulse. Now we have a pullback, expecting a new impulse. And as you can see right there, our next candle ends up following that previous preceding trend, where we then see price pushing the upside, taking out that drawn liquidity, following our CRT model, and then continuing the trend to the upside. Now, our very last example, we now have another trade where we have impulse, stop. However, keep in mind, this could either be our normal stop and reverse model, or it could be a stop and go model. In this conference, just having this is not enough to make a full determination to conclude our trade. Have you tapped into a POI? What is our previous trend that we're following to then validate if we're going to look for a reversal or a continuation? And as you can see right here, without added confluence of our previous trend, we will then see that price actually just continues to sweep below this candle, sweep that high, and then follows to the upside. Now let's get into a few more examples to fully validate all the formation that we've just learned to predict the next candle using the candle range theory. Now guys, we are back on fastball.com. As I said, the link of this site will be in the description below. Using our tiled window feature, looking at both GBUSD and USD to look at any SMT divergences or any correlation that may be in play here, okay? Now, looking at our chart right here, we can see that we have not only 1, 2, 3, but 4 bullish candles proceeding after one another. Now, this is a simple conclusion of our CRT model. We can just look for price to just continue this and make a new bullish candle. And on USD, we can see we have a impulse, stop, and then go model where price breaks above that previous candle high and looks like it's going to continue higher following this bullish trend. From this point, you can just look for the next candle to also be bullish. As I said, guys, from here, you can then go down to the lower time frame to look for your entry model. If you guys do need specific entry models, there are other videos I have posted specifically on how to trade a lot of these models. As you can see right here, we then see price make a bullish move to the upside. Why? Because simply, we've broken above a previous high, We're then looking to see price break above the next high. And same thing right here, we're going to see price follow through to the upside, okay? Now, this is our very last example, the most complex example, but the most important one, where you see price is consolidating on GBUSD. However, just before a major news event, we then see price make a massive move to the upside. From this, we can then understand that this is most probably our delayed response model, where just before news, we're seeing that there's a lot of consolidation just before a major event. You see that price consolidating, and we then see that first initial move to the upside. We're making massive moves, and then we are then followed with our normal impulse, stop, and reverse model. We then see price printing a reverse candle, now also having our pause in price, and we can then expect price to make another go, and that go will then allow price to make a bearish candle. As guys can see right there, we then see price starts to proceed down all the way to the downside.